Sluggish economy and high inflation are likely to lead to the Reserve Bank keeping the repo rate on hold, a slight relief for hard-pressed consumers following the January 50 basis points hike. With inflation expected to breach the top end of the target band of 6% in the second quarter of this year, the low interest rates levels may be gone soon.
We don't expect them to move rates, but we do expect them to move rates later in the year, purely because inflation is increasing. Now, with inflation, the two components of the CPI that are likely to undermine an inflation trajectory is an increase in food prices and also an increase in petrol prices.
With the possible increases in interest rates, analysts say consumers must be careful when taking big loans like a mortgage.
They should take into account, firstly, their financial position, what will be the effect of interest rates on their financial position and the effect on their mortgage repayments. They should also take into account that if they want to fix their rate, it can be that fixed rate can be higher than the current variable rate. So they must be then prepared to pay more for their mortgage loan on a monthly basis compared to what they are currently paying.
Economists expect the Reserve Bank to increase the repo rate by about 25 basis points in May to cap the rising inflation, but also to not put too much pressure on struggling households. This would also serve to avoid the ailing economy slowing further. Gloria Sefako, SABC News, Johannesburg.